only for...
Or yeah,
Oh, good, good. Living the good life.
I hear you.
Oops.
Awesome. Awesome. Nice to see you guys. Hey, Dave, Kevin, Brian, hello. Hello.
Hi, Maureen. How are you? Thanks for jumping
Good.
on.
Sure, sure.
The
You've been
signature
busy. You were
pearls, I
on
see.
last night too, right?
I'm sorry?
You were on one last night too, right?
I think this is my fourth night. But it's going to get me out of my pajamas.
I
I still got
Thank
pajamas
you.
on the bottom over here.
See Mandy flying around Chicago there. That's good.
You know it.
My computer doesn't support that for some reason. It's really weird.
Really?
Yeah, I don't know why.
If you have a green screen, it can.
Oh,
Yeah, so if you stick a green screen in the back of your computer, then it'll definitely support it.
Oh. Well, I
Here.
guess I'm getting the green
David,
screen.
I have a tip for you. Here's my favorite green screen. Hang on. I'm going to show you the green screen that I've got.
Can't wait to see it.
So let's see.
Yeah,
So it's sitting on the back of my chair. So if I move away, you'll see
Stop
what
it.
it looks like. There we go.
What? Dude, that is insane.
So, and it
Angel
folds.
wings
So
you got
when I'm
back
done
there.
with it, I fold it into a tiny little basket so it folds.
Yo, I'm emailing my assistant right now.
Yeah, Neil, I gotta tell you, I get some great, like the VA tips I learned from you, and that, like, I would love to. We should have a call for 10 minutes once a week, and
Perfect.
you amaze me at the stuff you're doing. So I think it's awesome.
I experiment all the time. I actually, my favorite experiment is not with VAs, it's with tomatoes. I'll send you guys my tomato video. So I learned how to grow these crazy ninja tomatoes that have kind of overgrown my backyard and are threatening to just take over other people's backyards. So, and I tried like 6 different kinds of soil and 3 different kinds of LED lighting, different soil depths. And then I kind of release them on the web and tell people, here's how to grow these killer tomatoes.
Oh, I got some tips for you because we've been doing the same thing. We have like a plant growing out of our fish tank right now, and we're doing the same crazy stuff. So we definitely have to chat.
and chicken eggs too, right?
We have lots of colored chicken eggs. Yeah.
We are top of the hour, and I think we are actually live to all of our attendees on video and. So if you want to know anything chicken eggs or tomatoes, we've got you people. Don't worry.
That's what everybody came for, right?
Right. Yeah. So Kevin, why don't you go ahead and get us started here?
Awesome. Appreciate everybody coming out today, joining us, hopefully in your pajama bottoms over there. We have a great crew with us, a lot of experience in the multifamily space. Quick announcement, so we weren't able to have Glenn tonight. He had a family emergency. So we have the CFO, David Tupin. He's a youngster rock star in the industry. We'll give some bios in a second. So quickly, some announcements. This is like a multifamily masters as well as lifetime cash flow property investors coordination to keep the education going, especially during these crazy times. And it's the perfect time to continue your education to be prepared for future opportunities. One thing I want everybody to know, this is educational information. So, make sure you consult with your legal as well as financial professionals on any of the information heard today. We have to put that disclaimer out, educational purposes only. And, the hosts we have here, myself, Kevin Dugan from Altus Investment Group, Mandy, if you want to introduce yourself really quickly, and then Brian as well.
Sure. Mandy McAllister, Good Fortune Capital.
I'm Brian Kokendorfer with ARC Equity Group.
And our 3 panelists today, Neil Bawa from the Grow Capitalist Group and Multifamily U. Would you give us a quick little 30-second overview?
Sure. I'm a recovering technologist. Love to experiment, love to come up with new ideas in multifamily. $265 million portfolio, slightly over 2,000 units. About half of that is new construction properties, and the other half are value add investors, properties in 9 states. So looking forward to this conversation.
Thank you, Neil. And then Maureen, would you give us a little bit of background as to your experience as well?
Sure. Maureen Miles. I'm with 4M Capital. We're vertically integrated. We also have a property management company I started a few years ago and a construction company as well. We've purchased over 3,000 units that were GPs on. And then we are in new construction value add as well, very similar to Neil. We're in 4 states. Yeah, I've been doing this for a while now. Just love the business, and it's fun. Keeps everybody from being bored. So it's a great business.
Very much so, very much. And there'll be a lot of insight today on the multifamily space and why it's a very powerful asset class, especially during challenging times. Lastly, David Tupin, young rock star in the space. Give us some background as to what you do and kind of what you bring.
Yeah, thanks, man. So David Tupin, partner of Obsidian Capital, bought a little over 600 apartments as a GP in the past 4 years, under contract and another 400 right now. So looking forward to getting up over the 1,000 unit mark here in the near future. I have just recently started a real estate software company as well, which should be launching towards the end of this year. Really excited for that on the acquisition side, multifamily space. So I've kind of played a role in all different parts of multifamily. I've been an on-site manager, I've self-managed, used third party, I've GC'd. So I guess a wide variety of experience across apartments. So excited to share with you guys tonight.
Thank you so much, you guys, for coming today and imparting some of your wisdom and experience. This is going to be an open forum, town hall type meeting. So if you have questions, please add them to the bottom. We'll make sure to get those answered so that you guys can have clarity as to what's going on. But I'll pass off to Mandy. I'll let her kind of start off the panel series over here with David, Maureen, and then Neil. We'll have some questions in between and then question and answer at the end. Thank you very much.
Yeah, guys, thank you so much. I echo everything Kevin said. We so appreciate your valuable time. So let's dig in. How are things going? What have collections looked like for April, and how are they trending now in May? Maureen, why don't you start us off?
Yeah, we're doing good. We did set the precedence ahead of time that rent was still due. We let them know. What we ended up doing with our properties is we had a drawing for everyone that paid before the 1st of the month. So everyone that paid in March for April rent, we had a drawing and somebody'd win half a month for free. So that we're just trying to let them know that, yeah, you still have to pay your rent. So we were getting that. That worked out pretty well. We had the drawing. We did Facebook Live events. We kind of made a big deal about it. So it was good. Collections came in. We had one property that's near a casino, and a lot of people got laid off. A lot of people work at the casino. So in the beginning, it kind of slumped, but the unemployment kicked in, everybody was caught up by the end of the month. So, the people that were slow payers are still slow payers. But we've opened up certain things like, we'll accept partial payments and things like that. But actually our collections were better than some other months last month. So because people got their stimulus check and, so it was good. We're not feeling any pain yet in this market,
And May was?
Yeah, May is actually on track. May is doing good. We had several. We did again the half off raffle. So we had a lot of people pay. Again, we've had some people pay 3 months ahead when they got their stimulus check and their unemployment. They've paid ahead. So that kind of surprised me. But we keep just stay in touch with everybody. We do have a hardship letter. I can go into all kinds of things we are doing that's behind, but we've collected right on target and not really off from any other month.
Neil, how about you?
It's been a pleasant surprise. I think a month ago I was really nervous. I didn't know what's going to happen, and I'm tied to data, and there was no data available. It was just a crapshoot, and had no idea. And so people asked me a month ago in a town hall that I was working in, what did I expect to collect? And I said, 70 to 80%, and being over 90% for April. And looks like May is slightly below that for us, so we might come in at 91 or 90% of what we were looking to collect. So either way, I think April was far better than we thought, and May actually looks far better as well, because once you started collecting good rents for April, everyone was like, oh, so it's not April that's the bad month, it's going to be May that's going to be the bad month, right? It's a natural tendency to have that feel that the bad stuff's going to come. But so far, today's the 5th of May when we're recording this. Well, so far so good. I mean, can't complain, right? I look at friends of mine that are running hotels, and other friends that have strip malls, and I'm looking pretty good right now.
Did you have additional communication with your tenants?
We did. It was very similar to what Maureen did. We've done raffles. We had one property that we were very concerned about, so we just gave everybody $50 if they paid before the 1st, and so a lot of rents came in for that one. We decided not to do that again in May, because I think that was a little bit too much, but we were nervous, right? And that was the property that had always been a laggard, always had high delinquency. And so we did it there, and that property came in ahead of what we thought it would, came in ahead of other months. So it didn't repeat that for me. I think we switched also to a raffle for that particular property for me.
Great. What about Obsidian, Dave?
Yeah, very similar to these guys. We did raffles. We did, gift cards if you pay before the 1st of the month. And so our lowest was 89% collections. It was in a more tertiary market in Texas, Corpus Christi. But all of our Dallas-Fort Worth stuff, the property in Atlanta I own, we're all above 90%. I think they're all in the 91 to 93% range, which is pretty comparable to most other months. But at a snapshot mid-month, we were definitely in line with March, which was a great month for us as well on most properties. So not a huge change. I'm curious to see what happens this month, come the 10th, 15th. But similar strategies to these guys, and like Neil said, there wasn't a lot of data to go off of looking into this. So it's like we just had to experiment with a bunch of different strategies.
And May, how's it tracking?
So far, my team just texted me. We're on one property in Fort Worth. We're at 77% already at the 5th.
Wow. Okay.
Yeah, which is really good.
Surprising,
so
huh?
I just asked him for that like 2 minutes ago. So I don't know the rest of them, but that was just one property in Fort Worth.
Well, the COVID outbreak, it's only been, a matter of weeks, right? But I'm sure we'll all agree that the impact of this is going to continue for a significant amount of time. So given that, what challenges do you all anticipate for the rest of calendar year 2020? Neil, what are your thoughts?
It all depends. I think that there's still a lot of fog ahead of us. I feel like we've had a really good month from a multifamily perspective, but there's still a lot of fog ahead of us. And the biggest piece of it is are we going to keep the R naught of this disease down? At this point, all 50 states in the US are below a R naught of 1. An R naught of above 1 means that one person infects more than one person, which means the cases will grow. An R naught below 1 means that cases will decline. And my early estimates are actually not very bullish. From what I'm seeing, places across the world that are reopening are finding it extremely difficult to keep the R naught below 1. So we've had outbreaks in places like Singapore. We've had outbreaks in Hong Kong. So it seems like the R naught bumps above 1 within weeks of opening. So if that gets replicated here in the US, then we are going to see a lot of challenges with delinquency and with vacancy that we haven't seen yet. Now, I do want to point out that within the US, it's interesting that when I'm looking at the data, the US doesn't look like one country. I mean, there are states in the US where the R naught, even after the shutdowns happen, was significantly higher than the others, right? So different states seem to just be in a different place. And then before the shutdown, also there was a very wide variance I'm going to stop calling it R naught because that seems very, very geeky. It's just the infectiousness of the disease in different states was vastly different. So looking at this as a US problem doesn't make any sense to me at all, given that the data is so different. So to me, a lot of it, the answer to your question is it depends. It depends on how the US tolerates an increase in death rate when the US opens, because at this point no doubt in my mind that we're going to see an increase as we reopen. I also think that some states are reopening a little bit too aggressively, and I think that there are shutdowns ahead for those states. Hopefully not at a state level. Hopefully it's going to be at a city level or county level that we do these kind of, open shut process. And I think that each time we do it, we'll get better at it, right? So right now everyone's like, let's reopen the economy, and hey, I'm an entrepreneur, so I'm happy with that. But I do think that when the first and the second state go back into a shutdown after this, a lot of people are going to learn from that. We're going to very quickly pick up what to do, what not to do, what are the sort of things that led to those pieces. And so I feel like it's going to be very state by state, very city by city, where I'm going to have some properties that are going to be doing really well in 4 months, and I'm going to have some that are not going to be doing well. And I think the ones that are in highly dense areas are actually much more suspect than the ones that are in suburban areas.
Totally agree with you on that. The infectiousness and spread in these dense areas has been far more significant. Dave, what are your thoughts? What challenges do you see for the rest of 2020?
Yeah, I mean, I think along with Neil, it's very location dependent. I mean, we're under contract on a property in Fort Worth right now that we feel really good about. It's right by another property we own that's had great collections and a good tenant base. But we're also under contract on a property in Michigan. And anyone that's following, Michigan has been hit a lot harder than most other states in terms of coronavirus, right? And there's a lot of issues there. So, what we did was we had $100,000 hard on that deal from day one. The sellers, which we're direct to, and they're more mom and pop, kindly renegotiated. They turned our money from non-refundable to fully refundable and gave us an extra 60 days on the due diligence, which was awesome. And so we did that right away. And so I think it's going to pose a lot of challenges for buyers that are really not prepared going into deals the course of this year with their equity and financing. I mean, a lot of people are going into deals not really having those kind of things lined up. I think a lot of people in the past really preached, find a deal and then the money will come, or you'll find the money once you find a good deal. But, I think a lot of people are going to see that a lot of people have tightened up on the equity side of things. So people who have deep pockets, who have cash, who have liquidity, who have investors who have liquidity are going to be in a much better position than those who don't.
Maureen, how about you? What do you see coming challenge-wise?
Yeah, so challenge-wise, we are doing a new build is one property that we ended up delaying. We were just about to close on it. We had the money raised, actually all in escrow, ready to close on the construction loan, kind of as this stuff was approaching. So we purchased the land, but we decided to wait until this stuff clears because I don't want to be delayed on permitting and things like that. Until we really see this area open up and we're confident, then we'll go ahead because we own the land already. We're okay with riding that out until we can get the rest in line. The bank, we are reaching out to other banks, but this bank that we have the construction loan lined up with is still, ready to go. So that's a good thing, but we are making plans in case they change their mind with all these SBA loans and all these different things. A lot of the, banks outside the agencies are tightening up and they're getting busy with all these, disaster loans and things like that. So that, and then once we do start, I am a little concerned about materials. So we are really making sure that we can source materials as we build 168 units. So that's something on my mind. That's something now that we're going through and making sure we have all the flooring we need. We can get all this. I mean, and there hasn't been any issues yet as to getting these, but we're trying to make sure that we can procure these ahead of time. As far as the properties go, we've always been really conservative with our rent growth. I think some people may run into problems where they've bought recently and they were projecting these, crazy kind of rent growth that maybe weren't proven. I think we may see some issues with those type of properties. And then, as far as the rent collection, the tenant base, there may be a shift. We're not really that concerned because we do have, number one, we have reserve funds, which we could pay the mortgage for several months. I mean, if this goes on for 2 years, we'll have an issue, but we have the funding to ride out any kind of issues we have that way. But as far as the renters go, you may have people that are moving from single family into rentals again. I wouldn't want to be in the A class space right now that may get hit, maybe, but you may have people shifting around. So we're not really, we have typically B is our probably standard, maybe B minus in some markets that, we're doing some value add. So people always need a place to live. So just like Neil had pointed out, I have some friends with, shopping malls, and the grocery store people are doing good. The salon owner is not so good. But as far as the, real estate in general goes, I think we're in the best place there is right now, multifamily.
Mm-hmm.
Yeah.
I agree with that as well. Yeah, for sure. Well, Neil, I had a chance to hear your analogy on driving through fog. I'm wondering, that was taped a number of weeks ago. Can you maybe shed a little bit of light on tell us what that analogy is, and then how far through the fog do you think we are right now?
Yeah, that analogy was made specifically based on a question where people said, would you be buying anything at this point in time? Should you be buying anything? And my answer was that I feel like I'm in the fog, and buying something is like accelerating your car. And right now, the more light I shed on this, the more glare I get back from the fog. So I'm staying away from buying anything. Like Maureen, I have construction projects, and actually we've had some unexpected things happen with two construction projects, one in Utah and one in Georgia. Both states considered construction to be essential, so we had no disruptions. And in both states, we had two crews, so framing two. In one of them, it's one big building, in the other one, there's lots of different buildings. And so the Utah ones, we were actually able to add a third crew because people in California got into their cars and drove 10 hours to Utah. And so all of a sudden, our foreman started getting calls from people saying, hey, I used to live in Utah. I used to work with you. I'm coming back. Can you get me work? And so we've now ended up 4 weeks ahead on our Utah project. We are 5.5 weeks ahead on our Dalton, Georgia project. Neither project has had any issues. So oddly enough, given that those projects are not delivering this year, they're delivering at the beginning of next year, I'm a little more bullish about construction projects right now that are beyond the lending piece. Obviously, as Maureen said, it's hard to get lending right now on new construction, especially on like mega projects. Small ones, no problems at all. If, we were building 8 quadplexes in Houston. That lender is like no big deal because it's a small project. But big ones, lending's a huge problem right now. If you're beyond that lending point, actually you're in this Goldilocks zone where you don't have to deliver product for the next 12 months and you're able to construct. Also, as Maureen said, we haven't seen any supply issues so far. So I am a little nervous about that. Luckily, America doesn't get most of its wood from across from Asia. Wood comes from Canada. So that's not a challenge. We're not doing a lot of steel construction, so we're not worried about that. But so far so good on that new construction piece. So I'm fairly bullish on new construction right now if you've gotten past the permitting zoning piece. Projects that we have in permitting and zoning have been delayed. One's been delayed by 90 days, one's been delayed by 4 months.
Does that affect returns or underwriting, or are you going to raise more capital?
Didn't have to raise capital for either one. It affected returns for both of them. Well, basically for both of them, we wiped out our contingency, our timeline. So we have a contingency for money and a contingency for timeline. Our timeline contingency on both of those projects is down to 0. So obviously, assuming that there are further delays, that will affect our returns, yeah.
So we haven't really had a tremendous impact on it doesn't sound like the collections have been tremendously impacted. So performance of those assets hasn't been a problem, but the new construction, there's been a hiccup. What sort of preemptive communication are you sending to your investors when you see potential concerns on the horizon? Dave, tell me a little bit about that.
Yeah, so like these guys, we're actually doing a new development right now as well. We're breaking ground this month, which I'm really excited about, and we were approved before all this went down. Interestingly enough, we decided back in January, before we knew about COVID, that we were going to build the property for cash. And so it's smaller than what these guys are working on. It's only 50 units, so the equity portion's under $7 million, so it's not a massive amount. for building it cash. But, we feel that kind of like Neil had that scenario where they have an extra crew now. We're seeing that cities are approving, at least here in Austin, less and less projects. And so we're also seeing contractors starting to reach out to us for the first time in 12 months when before it was hard to get in touch with them at all. Neil, you've probably seen that. Maureen, maybe you too. I don't know if you've noticed
labor's
that.
dropping, the cost. It's awesome.
The labor cost is dropping. And so we're actually really excited, especially having cash in hand, not having to wait for draws. We're going to be able to really, buy out a lot of these subcontractors, pay them quicker, get better prices and stuff like that. And so, and being 50 units, we don't see a huge issue with the supplies as well. And, 100, larger projects might be a little bit more challenging, but the one thing that we are thinking about is kind of the end fixtures, like Neil said, the stick, and, that's not a big deal for the wood, but once you go into the end fixtures and appliances, a lot of those we do source from China. So, as long as there's no issues there, I think really it should be smooth sailing the next 14 months as we build it. But, communications to investors, I think, we're just trying to communicate based on the market, because it really seems like the market is dictating how properties are performing right now. Mm-hmm. One city, you could be doing great, and another city, you could be doing terrible. So really giving them solid data on what markets we're investing in, and the fact that we're targeting strong markets that are resistant to a lot of this, I think is important.
Mm-hmm. Maureen, tell me about your preemptive communication with investors.
With investors, we let them know in the beginning that, we assured them that we are well capitalized. We do have a portion that we raise beyond CapEx, beyond anything that we can see. I mean, typically on a decent sized 150 or 200 unit deal, I mean, we have an extra 250,000 just that we just sit there. I mean, it's raised ahead of time, so it is expensive, an expensive piece in the capital stack that, investor money, we are giving returns on that money, but I call it my sleep good at night money. And I always have, I'm like, no, that's the part that keeps me sleeping good at night. So if there's anything we miss, and I mean, we sell a lot of these properties and normally that is never touched. But it's like, if you have some kind of crazy underground issue you weren't expecting, or just something, it makes the deal go smoother, having those funds. And that's what, that amount is a minimum. We have several projects right now, several $1 million worth of CapEx projects kind of planned out for this year. And so we're still going through with most of them as planned, but we do have a decent capital amount. So I'm not that worried about being able to meet mortgage payments or anything like that. So we just had to assure to the investors, worst case is we may have to pull, down. We do a pref return, so we may have to pull back on that if things really are suffering. But we made full Q1 returns for 2020, fully as expected. And knock on wood, I mean, we've never missed a payment or a deadline or a projection. So I hate for this to happen, but I mean, if it ever did happen, I guess this would be one of the reasons it was kind of acceptable. But for right now, we're still on target, and just reassuring them that their money is safe, their capital is safe, their investment is safe. We're very conservative on our projections anyway. So our rent increases that we're projecting were built in the day we bought them. We don't really buy things thinking that, we're going to get $200, we're going to lead the market and it's going to go up, 10% for the next X amount of years. We're always conservative. We have to see that rent raise availability like right when we close on it. I want to see it built in. And so we're just kind of chugging along as planned. So far, so good.
Well, that's an interesting idea. What do you think is a prudent upside to rent or rent increase over time through this?
It depends on the property. For some of the newer properties that we have, we know that there's X amount built in. Like I said, the day we buy it, some may have $50, some may have $100. We have a property we bought a year and a half ago. The average rents were around $700. We're renting them out now for $1,200 a unit, and we're doing minimal upgrades. We're not even like, redoing major amount of stuff. So it really depends on the property. And I think you're going to see the people that are overextending themselves with projections and maybe making poor choices or as the famous quote goes, when the tide goes out, you see you swimming naked. I think we're going to start getting some naked shots of people swimming.
Some naked syndicators. Yeah.
Yeah. So, but we've always been conservative. Our theory is always it's better to miss out on an opportunity than to, really shoot yourself in the foot. So there's been deals that have sold over the years, and you see them, back in 2014 or 2015, it's like, oh, that's way too much. Then you see it trade 18 months later for 10,000 more, and then you see it trade another 18 months for 30,000 more. You're like, oh, I missed that opportunity, but we stay safe. So I'm sure these guys on the panel understand too. It hurts a little bit. I missed out on that opportunity, but yeah, I know we're conservative, and our investors are safe.
The sleep well at night function, right? Very cool. That kind of leads into an interesting idea. So the opposite side of the we're running into problems coin is there's going to be a boatload of opportunity. So in terms of underwriting deals now and moving forward, how has how have your numbers changed? Do you have a different factor for economic vacancy, rent increases? Tell me a little bit about that, multifamily mad scientist, if you don't mind.
So the first thing that we did was we looked at which states have what percentage of people laying off. And because it's not a one size fits all thing, I do not want to do the same underwriting that I would do for Nevada or Hawaii. And I don't want to do that for Texas, because it's clear that Nevada is going to have a very, very high unemployment rate, and so will the state of Hawaii. And we've actually looked at a property in Hawaii. Don't look at a lot of them, but we looked at one. And so I believe that you've got to first look at the unemployment level of your state, and then you've got to look at the unemployment level of your city in the last 45 days and factor that into your numbers. It isn't something that we've done before, right? Everyone wants to obviously make sure that you're buying in cities with a decent level of unemployment, but it wasn't such a big deal. But today, I'm telling you, the biggest factor in your underwriting is going to be how many people will have jobs or not have jobs 2, 3, 6 months down the line. So start with publicly available data. There's now data available for how many of the 30 million people that have filed for unemployment, how many of them are in your state? And look at the total number of people in your state and divide that to see where that state's going. Every state's information is available. You can see Louisiana obviously is struggling right now because of that massive outbreak that they had in New Orleans. So there's examples of that. So all I'm saying is lead with the unemployment rate right now. There's no other factor that's as important as the unemployment rate, because that's going to be the massive 800-pound gorilla X factor that's going to affect your underwriting. So focus on that. Otherwise, use the same conservative methodologies that you're using. But if that unemployment rate is high, don't expect that it's going to come down in a few months. We are seeing evidence of long-term devastating damage in these areas that are seeing heavy damage. Now, light damage states are not seeing that much of an issue. Like Alaska, for example, I don't think anything changes for Alaska. But there are states like Louisiana that are going to, where the damage is so massive and the number of people laid off is so massive that the underlying foundations of the economy are shaky, and I think they're going to be shaky for 18 months. So you've really got to look at it. I mean, for example, I would underwrite a significantly higher vacancy for a Houston property, and by the way, I like Houston, then I would underwrite for Dallas. But even in Dallas, there's portions of Dallas that actually are seeing more of a hit. Also, there's no doubt in my mind today that Class C is going to be hit harder. When I'm looking at who's getting laid off, the overwhelming percentage of those people are people that make less than $40,000 a year. And Bs typically tend to start at $40,000 a year and go up to $55,000, $60,000 a year in income. And so when I'm looking at the damage that's being done, it's the Class C crowd that's being damaged. So if I'm buying a C, I'm going to underwrite higher vacancy. I'm going to underwrite potentially flat rents or even slightly declining rents. And then I'm going to look at the unemployment rate of that market and that submarket. That information is available to you.
So maybe a good follow-up to that is, that's how your underwriting has changed. What do you think the deals will look like in 12 to 18 months? What sort of a discount are you going to need to see to take a bet on these highly affected areas?
That's a hard one. I have to then make an assumption on where I think the economy is going to be. So I'm very bullish at this point that we will get a vaccine by the end of the year. As of 30 days ago, there were 13 vaccine candidates worldwide. Today, there are 108, right? These are all super smart billion-dollar pharmaceutical companies. Only one out of those 108 has to get it right. So in my mind, well, I'm pretty sure at this point we're on an accelerated path for a vaccine. And if that vaccine goes in by the end of the year, what I'm seeing is that the Fed and the Congress between them will somehow muddle through the next 7 months and get us to safety next year. So in my mind, 18 to 24 months from now, I believe cap rates will be where they are today. And a big reason why they're going to be there today, and I don't think that unemployment is going to be as low as it was in February to 18 to 24 months from now, but there is no way, and the Fed's already said this, there's no way they're going to be able to raise interest rates. So now you've got basically the US and worldwide interest rates running at zero, which means that bond yields are negative, which means that money will continue to flow into real assets. People are hungry for yield. And so when the market starts to stabilize, you're going to see an even bigger rush into real estate assets because this is a income producing assets where a lot of the others are not. You're going to see those changes. I mean, I think coronavirus changes things where cap rates for real estate, once we stabilize, and maybe that's 12 months out, 18, 24 months out, once we stabilize, the fundamental cap rate in real estate is going to go down because cap rates are tied to the money, to the risk-free money that one makes while buying treasuries, right? 6 months ago, 12 months ago, when you bought a 10-year treasury, you made 2%. Today, you want to buy a two-year treasury, you make 0.5%. That means that you make 1.5% less than you did 6 to 12 months ago. And that's not coming back. The Fed's already talking about keeping interest rates where they are for 3 to 4 years. So when the risk-free return goes from 2% to 0.5%, there's more room for cap rates to go from 5.5 in the United States or 5.25 down. I'm not saying they're going to go down 1.5%, but I think they could go down 0.75%. 0.75 cap for $1 trillion industry is an incredibly large amount of money. So in the 2-year time frame, I'm very bullish. Over the next 6 months, there's still a lot of fog. I don't know how my properties are going to be doing. I mean, I've even pulled out home equity, all of my home equity. I pulled out 100% of that and I stuck it in the bank, and I'm paying interest on it because I might need to support my properties going forward, and I'm prepared to do that if I have to. So far, so good. I do think that it's possible that in Q3 and Q4 you might see some price declines, but I no longer believe that you'll see radical price declines. There's just so much support from the Fed. There's so much support from Congress that whatever declines there might be are going to be fairly momentary. So you might see them in Q3 and Q4. You might see them on weaker deals where they're down 5% or 10%. But I no longer believe that. And a month ago, I would have given you a different opinion. I no longer believe that we're going to see double-digit declines in pricing at all.
Maureen, what are your thoughts on that twofold question? What do you think deals will look like in 12 to 18 months? And what underwriting changes are you doing on those properties now?
Yeah, so as far as what deals are going to look like in 12 to 18 months, and even now, I do believe that there will be opportunity kind of sporadic out there. I think if somebody needs to sell, they could be in a tough spot. I think financing for things, I mean, right now, the agency, what we're seeing is more reserve and P&I is what they want, up to 18 months in some cases. But I think that's even pulled back now from a week or two ago to where they're just looking for 12 months where they're making you reserve principal and interest, even on a performing asset. That's something we do on a bridge loan typically, but not for a normal property. So we're seeing that. And I think for some of the smaller properties, that lending has really gotten tight. So I think there'll be a lot less people qualifying for those loans. The LTVs seem to be going up. So you have to have more of a down payment. We're seeing some offers of 65 to 70%, where before we were seeing 75 or 80% LTV.
Loan to value, yeah.
Although that's even seemed to lighten a little bit recently as well. Just even like this week, we're seeing that kind of tick up again, which is good. So that's the way we see it. Like Neil said, I think this is one of the safer places to have your funds right now. You know, with all this influx of money, we see that, to me, I'm kind of looking for maybe some inflation coming down the line, right, with all this new cash. And don't forget that some of the people that run the country are very heavily involved in real estate as well. So I don't see real estate dropping, just like, dropping off a cliff like some people are projecting. Again, single families, I think they're going to take a hit. I think there's going to be less people able to buy homes coming up. I think that's going to tighten. I think there'll be some fallout from that. There's a lot of funds raising a lot of capital right now to purchase some of these CMBS type of product, some stuff going on there. So I think there will be some issues in the market, but I think where we are in this space with multifamily, it's definitely going to be one of the safer places in real estate. As far as what we're doing, besides considering that that P&I that people want escrowed now, or that the lenders need escrowed, I think it comes back again to fundamentals. And with the craziness of the real estate market, you see more and more people kind of getting away from that. But if you stick with your fundamentals, when we underwrite or when we perform a due diligence on a property, one of the things we look at is leases, right? You want to see where they work, and you want a diverse workforce. If, we want people that are all over the place. We want to see teachers, we want to see nurses, we want to see people that work for the cities, police officers. Like, we love to see the mix of people that work the factories. It's always a red flag if you're finding 80% of your workforce works for one company. Well, I don't want to say, there's always, like, we'll do a little bit of Section 8, just like maybe 10% or less typically we have as a thing. I mean, right now that's probably more attractive. So I know Neil had commented on the C. Sometimes you might call that going into the D range, but I mean, those properties, those people are still going to collect money. Maybe some of the older kind of retirement communities type properties or the assisted living, those will probably be chugging along. I know they're having their own issues now, but like student housing, we always kind of stayed away from student housing, because I said if we ever had to switch to a normal conventional kind of renter or family, that we would have a shift if we bought at that higher rate of collections that student housing provides. So I mean, I think student housing right now is unsure of, because we don't even know if universities are going to be going back to the same level. So in that range, I would be a little concerned as well. But cash is king again in this environment. I think there will be some opportunities for deals that are maybe falling apart now because either lending is getting tripped up, or people are trying to retrade and it's not going well. So I spoke with a broker recently, and I think they said about half of their deals that they had under contract are falling out of contract now. So if you can wait, I think a lot of sellers are just waiting until things calm down. We have a property that we were looking at maybe exiting at the end of this year. And, we're waiting, but we can ride it out another year if we need to, which is what we'll, but if your loan is coming to an end right now, and for whatever reason, you're not in a good spot to refi and you need to sell, that could be a potential deal right now too. So I think, pay attention to, just deal availability. They will be popping up, but I don't expect everything to just be on sale. Like, back in 2011 or 12, where just back the truck up and load up everything you can. Like, I don't think that's coming down the road. I think you might be disappointed if that's what you're going to wait for, but no.
Dave, what do you think on that question?
Yeah, I mean, I'm probably leaning more on the side out of the three of us of there's going to be a lot of opportunity, especially closer, in the next 6 to 9 months towards the end of this year. I think any type of situation like this, there's just so many situations that you probably can't even think of right now that will cause somebody to sell a property for less than what they really should. And, that might be, like Maureen said, financing coming due. It might be, the lack of buyers right now. Lenders are tightening up on their expectations for the strength of a buyer, for what a buyer has to bring to the table. And a lot of lending requirements are changing. So right there, it cuts a lot of buyers out of the market. And what we were seeing before, I think, was a lot of supply and demand, right? When a broker has 20 people offering, 10 of them might not even be qualified to buy it, but just because of the perception and the demand on that property, it drives up the price inherently, right? So I think that we're definitely going to see an overall softening on prices. And then I definitely think that, a select amount of deals, maybe, the bottom 10% or 20%, we're going to see some really great deals come about. I think we're going to see some phenomenal deals, and the people that they might not seem like phenomenal deals, but relative to where we're at now and where we were at before, the ones that buy that when we return and resume to normal economy, hopefully within the next 18 to 24 months, I think the people that did get a little bit aggressive, still stuck to the fundamentals, but that got a little aggressive and had that cash and capital and the ability to close, you're going to be coming out on the back end with some really good deals. So, at the end of the day, though, you have to stick to the fundamentals. And I think with multifamily, that's cash flow. If it's not cash flowing, if it's not safe, if it's not in a safe area, even more micro than what Neil's saying. I think what Neil was saying was super important about the market and understanding unemployment. You have to really even more, I think, really who are the employers nearby the property too. I think you guys would probably agree, right? Because if you're in a market with overall, decent unemployment, but you're right next to American Airlines headquarters where they just laid off 5,000 workers, half of those could be the people at your property. And it might seem like a great deal, but you're going to have 50% delinquency. So you have to be really attentive to that. But I think the people who put in a little extra work and are attentive to that and are still heavily looking at deals will find some great opportunities.
Yeah, one of the things I just wanted to add that we're enjoying right now as we are looking at deals is that there's less competition out there. So I'm sure Dave and Neil can say, so it's not so much where every deal, if you don't have 100 hard, like you might as well not even put an offer in, right?
Yeah.
Or, and financing contingency is coming back in. I mean, I haven't written a deal with a financing contingency in like 3 years. So we actually wrote one out. So that's really nice.
It's so lovely to get away from the whole 200K down. I mean, I was looking at $200,000 down on day one. And, even the fact that I was considering it, like the left part of my brain is saying, what the fuck are you thinking, Neil? I mean, imagine actually, putting down 200K on a property that you haven't done due diligence on. And the broker saying like, there's 6 other guys willing to do that. And I think 5 of those guys have vanished and the 6th guy is going to vanish in the next few weeks.
Right.
And so, it's nice to be in a more sane, environment. So that's nice.
I think, yeah.
Oh, I'm sorry. Go ahead. Yeah.
No, yeah, I think that perception in general will drive down some prices. I mean, you're gonna see a lot of buyers leave the market. I mean, that demand level will go down and it will drive prices down.
We had a deal we really wanted this deal. It was a well-priced deal, really liked the asset. Our offer was $400,000 hard and we lost it. We didn't even get it. So
oh my God. Wow.
I was like, are you kidding me? Like, yeah, it was crazy. So
that is makes my palms sweat a little thinking about that. One more kind of COVID related question here. You've all done super creative things in some of your value add assets to be able to bump rents. Like there's dog parks, there's pools, there's tons of things that pre-COVID you could include in a community to be able to bump rents. Given this social distancing stuff that's going on now, do you see a change in those kind of community things that you'll be building moving forward? Neil, tell me about that.
Yeah, we are actually now building properties with less amenities. We're actually increasing the amount of outdoor spaces and we're taking those outdoor spaces and chopping them up. We're using faux boxed wood so that there's actually hedges that are about 6 feet high and they're on 3 sides and the 4th side is open. So we're taking our big open areas and kind of chopping them up a little bit. And worst case scenario, if this whole thing just goes away, I just have to get rid of a bunch of faux boxwoods. So we're doing that on multiple properties at this point in time to create these areas that are a little bit more private. We've moved away from some of the indoor amenities to doing more outdoor amenities. We've kind of lowered our cost by doing that, and we're going to pass that on to people in terms of rent. We're looking more favorably at properties that are near parks because we think that parkland, if this goes on for a while, parkland is the new beach. I mean, that's what people want. They want to be near parks where they can still jog outside. They don't want to be cooped up inside the house. The other thing that we're doing is we're raising the height of our ceilings. So we're going from 9-foot ceilings to 10-foot ceilings, because if people are going to spend a lot of time inside their house, I don't know if you've seen the difference between a 9-foot and a 10-foot ceiling. It is incredible. There's amazing roominess that comes with that 10th foot. I think it's worth the money at this point in time because I can move my product much faster.
Excellent
Agreed.
point. Maureen, post-COVID, what do amenities look like in your
Yeah,
assets?
so we're actually looking at doing things like more of a fiber feed to the property and just kind of ramping up internet access and having those high connection. We'll get some Google Fiber and things like that. So we're looking at providing that. And like Neil had said, we're not building Class A plus like in the market we're in. We're kind of building a more of a, it's like a new workforce housing. It's a kind of a newer thing that we're putting together. But so we're building brand new that Class A. But I think balconies are definitely important. You know, that's definitely going to be a plus if people are stuck at home. But you know, just having green space, but we are looking at like a garden area. That's something that we had looked at previously to COVID. So we haven't been changing a ton of stuff, but we weren't huge on the kind of excessive amenities like you see in some locations anyway. So not really that much. Just I think we're putting a fire under our people that are bringing the fiber in and stuff like that to look at those kind of offerings, you know, where internet's included and all that kind of stuff. So,
Dave?
Yeah, I love that you guys both said that because I think I have some investors in here that are working with us on our new build project, and now they know we're not crazy. So we're building ours same way, right? We have 0 amenities on our new construction project, except for garages that they could lease. And so our thought process there was, hey, everyone is building this brand new Class A product, and they're all pushing amenities is the reason why they're going to be charging $200, $300, $400 more. And so, you know, they're building theirs for $180,000 to $200,000 a unit for some of these Class A garden style properties,
Or more.
We're building ours all in with land for about $131,000 a door, and we have 0 amenities. So our rents will be, you know, $200 less than theirs. But I think there's definitely a market, especially in a place like Austin, where rents have gone up so significantly in the past 5 to 10 years. There's a market for people that don't really care about the amenities. They like the green space. They like being outdoors more. They don't need a gym or a pool or a yoga center or whatever it is, right? So, yeah, that's our thought process. I think we're all on the same page.
Very cool. Well, and Austin's a tech town, so I'm seeing a lot of questions coming through Q&A. I think we have a bunch of newer investors in here too. So maybe let's just kind of throw one last question here, and then we'll turn to Q&A. If you were getting started today, you know, what are maybe the top 3 things that you'd be doing? Dave, tell us, you're starting today. What do you do?
Yeah, if you're just starting in apartment investing, I mean, and maybe I'm contrarian to a lot of people in this, but you know, everyone says go out there, buy a 100+ unit deal. I really don't think you should do that if you're just getting started. I think you should start in your backyard, do something that's over $1 million loan so you can get a Freddie Mac small balance loan, buy something that's not a crazy lift, and you know, get acclimated with the space and get acclimated with the syndication process, maybe like 20 to 40 units. And buy your first deal somewhere close to home. You can figure it out, maybe self-manage it and learn. And then you've got the track record and the experience to go bigger from there.
Maureen, what do you think?
yeah, I'd say just make sure you're buying something that, number one, you have a decent capex around, you know, you earn access to a credit line or something. When I started in this business, I started with 2 families, 3 families, 4 families eventually. And, you know, I'll tell you, I was stuck when we had a furnace go out like the day after Christmas one time. And I was like, I had room on a credit card. Like, that's how I paid for that furnace. And it was a nightmare. And we never had a deal or a property that as soon as somebody moved out, like I had somebody literally, that sucker was rented. Like if they let me go in and paint cabinets or paint something or redo flooring while they were still in there, I would do that because I just couldn't afford to cover the mortgage all the time. So we literally started on this shoestring budget. So I would advise not to do that, especially in this time, unless you had access to funds. But you know, that just make sure real estate is great long term. It's the valleys and the peaks that that you just have to be able to ride. So
Mm-hmm.
that is my biggest thing. No matter what size the property, if it's a 2-family, if it's 200 units, make sure you have that extra capital to ride out surprises.
Mm-hmm.
And if you're brand new, I would say make sure you have somebody experienced that can look over your projections, make sure you're not missing any expenses. I mean, that happens in any environment, but right now it's just so much more critical. I would probably look at maybe security deposits too. I know depending on the market you're in, right now we're just paying more attention to that, kind of redoing it, see if we can get higher security deposits. So if people do fall behind, or we have any issues like that, we have a little bit more security. And make sure you have your money lined up with your lenders. I think the LTV amounts will be a little different, and you'll need more money down, so make sure that's written into your underwriting.
So a quick follow-up to that, you mentioned the Sleep Well Fund. I saw a question in the Q&A. Is that proportional? How much is that for each one of your properties?
I wish I could give you a direct mathematical equation, but it really depends on what I see as potential risk for the property. If it's a little bit older property where I'm thinking, well, maybe there's some underground issues I'm going to be, going in. We typically try to stay away from them, but if it is in a property that may have some galvanized, water feeds to the property, we know, okay, if we have to replace that, it might cost me 150 grand. So I may up that one. But on a typical $10 million deal or so, it would be no less than 250,000. That's kind of like the number we just throw on at the end. Pretty much, that's just a cushion. We typically are conservative in our other numbers anyway. If we're going to do roofs, we'll have some extra money built in there. So we kind of add to that as the different CapEx projects go along. But I would say no less than that. I'm trying to think of if I had to equate that to a number, it's really what you can afford and what you can work into the deal. Because the more you have, the better. But as you get more of a portfolio, so if you have 10 2-family houses, you can have that. Sometimes we call it a sleep at night fund, a slop fund, whatever you want to call it, right? Oh crap fund. So whatever you want to call that. But you can, I have my own resources, but then every property has its own too. So I would say it really depends on who the partners are in the deal, how well funded those people are. But I would make sure that I could cover in this environment 6 months of mortgage payments at the very minimum. Yeah.
Great advice.
I wanted to add something to the previous question, Mandy, and that was, what would you do today? The first thing I want to say is, number one, wait. The next, if you haven't started yet, if you don't have a huge pipeline, you're probably going to get a lot better deals in Q3 than in Q2, and you're probably going to get a lot better deals in Q4 than you will in Q3. But right now is actually, I'm finding, is a phenomenal time to message investors. They're scared. They're afraid. They're unsure. You can be that person. You can be that rock. We do these weekly town halls for our database, and we've done 4 of them. The 5th one is on Thursday. We've maxed out our massive Zoom license 5 successive times. We already know that the next one was sold out because we see how many people are enrolled. And why is that happening? Not because I'm a great speaker, but because what's happening right now is so unique and different that everyone's looking for information. This is really a great time for you to get in and be that trusted advisor for your investors. And normally there would be a lot of noise, and there's a little less noise today because there's a little less deals being thrown at them. So we've taken the approach of not even pushing deals at our town halls. No one talks about projects. No one throws up a PowerPoint deck. But what we've been able to do is to really establish a massive mind share with our investors. So when we're ready to go in at the end of this quarter or in Q3 or Q4, we feel very strongly that our investors are going to give us that money because there's also pent-up demand. You may not be ready to go yet, but you're right. You expect that, you haven't been out of the house for 60 days. When you finally go out, you'll probably buy something. So there's pent-up demand in all areas, and there's also pent-up demand in investing. This is a great chance for you to message your investors and provide high-quality content to them. You're going to see the rewards later in the year.
And your answer to what you would do if you were a brand new investor. your first three things?
No, well, to me, I think the first thing is I'd wait. I want to
Oh,
wait
I'm
until
sorry.
more deals in
Yeah.
Q3 and Q4. If I'm a brand new investor, definitely want to tell you what Dave said was key is buy small. Don't
Mhm.
look to do the 150 unit thing that we've all been doing for years. Right now is the time to buy a 50 or 60 units and really look at the quality of the area more so than anything else, right? So
Mhm.
the quality of area has always been important. In my mind, it's now oversized in its importance.
Got it. Very cool. Well,
One of the
thank you.
things,
Oh, go
if
ahead.
you don't mind, Mandy, yeah, just saying the new investors, something I learned really early on when I used to do the 2 and 3 families is I had a 3-family unit or a multifamily house that was 3 units, and I had the same family living in different floors of this same house. The mom and the kid lived in the middle floor. Like I think it was the grandmother with like one of the uncles was upstairs, and the brother was downstairs with his kids. And I was just feeling generous one day, and I said, I'm like, you guys could pool your money together, and you could buy something like this. And you'd see, I was making about $1,200 a month in cash flow just off this one 3-family house. And I said, you guys pool your money together, you could buy something like this. And I knew they were capable. They all worked, they had good jobs, they had decent credit, they totally could buy something like that. And they looked at me and they go, Maureen, they go, you're so crazy. They're like, you can't buy a house and own a house. And it really made me think that, some people are just programmed. It's not,
Mhm.
they're just programmed. They rented, their parents rented, their kids are going to rent. And so I think anywhere where you're in an environment where somebody can work at Home Depot, or maybe 2 people can work at Walmart and they can afford your rent. If you're in that $700 to $900 range or something, I think you're going to be pretty safe in the environment. You may have to change some people out because maybe some of those people are, they lose their jobs, but other people are going to be right in there behind them. So I think you'll always have a good rental base in that, as long as you keep your properties well maintained. You keep the trouble out, make people feel safe. And I mean, I think multifamily is a win in no matter what the environment. In that scenario, you'll always have people to rent to. So just wanted to share that for new people.
I love it. Very cool. Well, I'm going to throw over to Brian here. We're going to start our Q&A. I'm so grateful for you answering all our questions today. So, Brian.
Yes, thanks, Mandy. Couple questions for everybody. David, starting off with you. Talk about a couple of quick underwriting adjustments you guys are making. Specifically, how are you factoring in rent increases going forward and economic vacancy? Has that changed at all for you? And what are you underwriting right now on deals that you're looking at?
Yeah, great question. So I think what you have to do is look at the deal and assume that you are going to get no rent increases whatsoever for the next 2 to 3 years, and just see what that looks like. And once you start to look at several deals like that, you're going to start to see a trend, right? Some deals automatically will make no sense. Some will make 1 to 2%. Some will make 5 to 6%. And so you want to just be kind of on the higher end of that range. I think what's been really interesting is anybody in the past probably 10 years, starting two years ago, going back, who bought a deal probably made money on it, right? Over the past 10 years. Doesn't matter how smart you were, like you could buy a deal and the rents would have gone up. You would have gotten increases, the value would have gone up. And so I think right now what you really have to do is really understand the numbers, really understand the rents. Don't bet on huge increases from renovations. Maybe assume going in just the first run through on the numbers that you're not going to get any rent increases, like I said, and just see what that looks like. And then play around with some of your economic vacancies, increase it, drop the physical vacancy 5-10%, see what that looks like. Drop your bad debt, up to 5-10%, see what that looks like. And just start to get a feel for that. We were prior underwriting deals stabilized with like a 12% economic vacancy factor, maybe up that to 15 to 18% for the first couple of years, and start to see what that looks like. So I think it's a factor of just playing around with those numbers, and then buying in an area where you think there's going to be minimal effect on that compared to other locations.
Thanks.
Just wanted to add that the next 3 or 6 months, it may not be a bad idea for you to lose some deals because you were too conservative. I think that there's going to be deals in the market. I think that there's going to be price declines. So if you're starting out, lose some deals. It'll get you a better feel for it. In the next 3 months, it may be too easy to win deals if you start applying the same criteria that you were applying in February.
Correct.
And if you don't, change enough, you could be that one sucker that buys a building at a cap rate that it no longer deserves. I fundamentally believe that there's going to be decline. 10% is my number in terms of, multifamily, but could be 7, could be 8. Not sure if there's going to be double-digit declines. And there's going to be some areas where the declines will be higher. So, that's an average, which means that you are about to get better deals than anyone on this podcast was getting in February. So be happy with that. Don't go a little bit, overboard. You've already banked 5-10% price declines. And at least be on the conservative side. Be happy that you don't have to deal with the $200,000 or $400,000 in going hard on day one that we've had to deal with for the last 2 years. So you've got some advantages over us, but you've got to use them.
Yeah. And to piggyback a little bit on that, we're still in a really weird period. So I think, like Neil said, the next 3 months, we're not going to see anything great. It's the financing has been super strange. Buyer to seller pricing expectations, there's a huge gap still, right? Because the pricing expectations were so significantly high end of 2019 through January. And now buyers feel like there should be a 30% decrease in price, and sellers are like, maybe I'll put up with 5. So we still need a little bit more time for the dust to settle to see where that really shakes out and where the price expectations are going to be. And then also, if you're under contract on stuff right now, get as many extensions as you can built in, whatever you have to do. Because if you're having to close on a bridge loan right now, I am getting quoted on, I went to 50 to 60 bridge lenders in the past 3 weeks. And in 3 months, they changed from, LIBOR plus 375 to 450, which would put you in like a 5 to 6% interest rate range, up to now we're seeing almost all bridge loans for non-stabilized deals in the 8 to 10% range. It's incredible. And so that was last week. This week I just got one from Arbor that was LIBOR plus 500, and that's the best one I've seen after going to 50 to 60 different bridge lenders for a 70% occupied deal. So it's not stabilized, but that was the lowest interest rate I've seen, was a 6% rate floating on a non-recourse bridge loan. So 2 more weeks you could wait, the dust could settle, and everyone's expectations might come down. Buy yourself some time. Don't make any hasty decisions because of what's going on.
Yeah, I think the lenders are always, I joke around with my my lender that, they're like, oh, well, rates dropped, but the spread increased, Maureen. And I was like, oh, did somebody sneeze in Oklahoma and now they can charge an extra 0.5 point spread, right? Like they can't, it's just the most ridiculous. So any reason they're like, oh, it's raining on Tuesday, we're going to increase spreads today. Like, and they tell me that's not the way it is, but I think that's just the way it is.
They're gouging.
So, yeah.
Yeah, we're being gouged on bridge loans right now.
Yeah.
Seriously.
So yeah, I think it will continue to, as the dust settles and things become more normal. I think that things will get a little bit lighter. So like I wouldn't close on something right this second unless it was under dire straits. But otherwise, yeah, push it out. That's great advice, Dave.
Yeah. And Neil, you were talking about preaching patience earlier. A couple of people mentioned, do you feel at all like with, in April, everybody was working in March for the most part. So they were able to cover April's rent. Then the stimulus checks came in and people who lost their jobs are getting unemployment. You guys feel like in 2 to 3 months is where we might start seeing some of the, rent collections drop versus now? Do you think it might be pushed off because of that?
Well, there's both good and bad there. So there's going to be people that haven't gotten hired back in May simply because those businesses have not started up. Businesses are also starting up in steps. So if you're a hair salon, you might not start up in May at all. You might start up in June. So the person that was at the hair salon might not get hired back in July. So the hiring process, those 30 million people that are getting laid off, they're going to get hired back in steps. And as the unemployment money starts to run out and as the stimulus checks start to run out, we should see another 5 million people get hired, another 5 million people get hired. So I do think that there's a balance there. And no, I don't see, like August being much worse for rents than, let's say, May and July. I think that we're just going to muddle along and not make as much money as we were making before. But I don't expect it to go downwards because more people are coming back. And also, a lot of this is in the mind, right? I mean, a month ago, beginning of April, everyone was like, oh my God, the world is ending. What is this? This is crazy, right? And everyone's shut in their homes. You're not in that home anymore, so mentally people are feeling better, and I think that is also a positive. And we did so well in April with everyone just hearing bad news. I mean, in the first half of April, every single piece of news was either bad or horrible or truly world-changingly bad. And now we're beginning to also hear some good news, so there's some balance in the marketplace, which is why I don't believe that August is going to be horrible compared to July or worse.
And I'm wondering too, I mean, you think about what kind of opportunity is open up. We're here a lot about, and not to get into politics or anything like that, but we're here about not relying on overseas for so many things and having more manufacturing coming back here and more things sourced from the US. Or I think like Texas, we're all kind of in Texas one way or another. And I think there'll be more things maybe brought up through Mexico. I think we might be looking at different countries as sources of supplies and things. So there may be more, the jobs may change, but I think there just may be some different types of jobs out there that will hire. So I don't think it's going to be this declining thing where things are going to shut down. I think it's just change, right? It's change. And in multifamily, if you guys are looking to get into it or whatever, and you're not good with change, you may want to think of something else, because I think one of the reasons we all like this is we probably all get bored a little easily. And this stuff is, it's not the same every day. No matter how many things, we think we've seen it all, we're still pleasantly surprised with more opportunities and more challenges. So things like this, you have to just learn to roll with.
Yeah. And Maureen, you were talking earlier about your early communication with your tenants and how that helped your collections for both April and May. Have you had any issues with tenants that have been taking advantage of the eviction freeze in certain states? Like I know in Illinois, for example, here in Chicago, evictions have been frozen for April and May. And so a couple of people asked about if you guys have had that issue and how you're dealing with it.
Yeah, so I was actually on the phone with one of my managers about 2 weeks ago, and she's like, "Oh, excuse me, Maureen." She goes, "Hang on, this lady, I've been waiting for her check. She's waiting for, I'm not sure for the stimulus or unemployment or whatever, but so she's like, has me on hold for a second, just like, but I can still hear the conversation. And she's like, "What do you mean?" So the lady had said she would pay her rent later in the month, but now that she heard about all these moratoriums on evictions and stuff, she said, "I have the money now, but I don't think I have to pay you now because you can't evict me." And my manager's response was, she goes, "I'm going to pay the expedited rate to make sure you're first in line if you don't pay me." And she ended up paying for her rent. But I just thought that was a great response. Like, so, awesome. We have to share that there is a limited amount of time, but they will have to pay it. It's not like it's going to be, this thing where they think they're going to have free rent. It's like, I'm not going to go to the grocery store and get free eggs, right? So you just have to set that expectation that it's now or later. And I mean, my manager happened to have, I think she was just kind of pushed to the limit with this tenant already. So, but it's just like setting those expectations and just saying, you know what, as soon as that opens up, you're going to be first in line if you're giving me a hassle like that. So, but I honestly, I have been pleasantly surprised with the amount of people that, we've seen very little of that. And it's the people that are probably trying to get away with it every month regardless, the ones with the excuses, or I left it in the drop box, or I mailed it, or those kind of people are going to have problems with. But just set that expectation that the evictions will come up and they'll have to do it. I also know some colleagues that are doing cash for keys now, the people that they know that they've had problems with and they are continuing to have problems with, they're offering them to vacate, because we are seeing people that are looking for rents right now. And if we don't have the availability, we're looking to fill those spots.
Yeah. David, you're under contract with a couple of properties, you said right now, and a few people have asked about the additional reserve requirements that lenders are requiring. So Fannie and Freddie are requiring anywhere from 9 to 18 months of additional principal, interest, tax, and insurance. how are you underwriting for that? Are you underwriting for that as initial capital upfront and then a capital event where you get it back in 2 to 3 years? How are you guys factoring that into your underwriting right now?
Is that a question for me or for David?
Both.
Okay. All right. Go
Yeah.
ahead, David.
Yeah. So we're raising that as additional capital up front. I've got a couple quotes right now for Freddie small balance. I've got a couple Fannie quotes in, and they're all at 12 months flat. And so we're anticipating that as capital up front that we have to bring to the deal, in addition to the down payment and CapEx. And then I'm anticipating that it comes back at the sale, actually. Two different scenarios. So I'm running that either comes back at the sale or that we have no mortgage payments for the first 12 months, because they haven't, not every institution is fully clear on exactly how they're going to apply that yet. Some of them have said we're going to apply that over the first 12 months payments. And so you won't have to make a payment. You'll have higher cash flow in the first 12 months. And then some, it's just escrowed and sitting on the side. You still have to make continual payments. So I think it depends. You need to talk to the lender. And like we've kind of been going back and forth, but this stuff's changing week by week. So 12 months is what I've seen, though, across the board for a stabilized agency loan.
We're doing something completely different. We're financial engineering that 12 months, and we're doing a new equity tranche. We call it short-term equity. So we've split our equity into two classes. I don't want to be paying 5 years to these people, so I'm basically giving them 10 to 12%. Think of them as preferred equity. I know that I'll be able to pay them off. So basically the way I'm writing those contracts is that I can pay you off after 12 months, or I can pay you after 18. And if I still haven't paid you off at 18, whatever remains of your equity that I haven't paid off becomes permanent equity. So you have the chance to become permanent equity, but you probably won't become permanent equity, and I'll pay you off. And if I pay you off, then I'm paying you a 1% a month or something like that, which is a lot less than I would pay, to double an investor's equity in a 5 or 6 years project. So I'm creating new equity tranches. It's financial engineering, but it's very profitable to do it that way. You have to have a large investor base to make that work, because out of 10 investors, maybe 1 or 2 will opt for this pref scenario at 10 or 12% annualized, and they know it's short term. They know it might be 12 months or 18 months or 24 months that their money stays in. So as long as you have a substantial database, this makes all the difference in the result. And in the end, I'm still paying the same amount for the property, but it's allowing me to get around this issue. And I believe completely that this is a temporary issue. If you look at the last 50 years, we haven't had a year's worth of impounds. We didn't even have that in the Great Recession. So we believe that this is temporary. Lenders are just shit scared at this point in time. I think that there will be normalcy. And for me to basically pay more equity for 5 years doesn't make sense. So I'm creating new equity tranches.
That's a great idea. And I think on top of that, like you said, wait 2 months. If you could buy yourself 2 months, that might go away. Seriously.
Exactly. I'm not even sure this thing is going to be there in Q4, right?
It was 18 months. Yeah, like a week ago, right?
It was 18 months a week ago. Give yourself 2 months and this could literally go away, and you might not have to worry about it. So we're not closing any deals right now because of that. We're pushing everything out at least 2 months.
We're just using into our kind of reserve funds, whether it's for CapEx. Say, okay, can we wait to put this, roof on? We know during our hold period we're going to have to redo roofs, or maybe we have a window project budgeted, but we'll just wait and have those funds kind of rolled into that right now. And just like you said, Neil, too, that is a great way to handle that. And we always have the investors that say, hey, I can't have the money in there for 5 years, but I have something, I need it in 24 months. Do you have those type of loans? And they love to earn more than I don't even know what a bank is given now. Like, are you paying to
Bank's taking money? Like, give me money.
Them, right? Now,
and then I'll take more money from you. It's just ridiculous.
Yeah. So
there's no value for cash today.
Yeah.
We'll get down to our last 2 or 3 questions here. One of them, what advice would you have for somebody who's in a 1031 exchange right now? I know most 1031s, they got delayed until July 15th, I think. But, somebody just closed on a property in March and they're in the middle of a 1031 right now. They don't have the option to be patient waiting, 2-3 months. What kind of advice would you give them?
That depends on how much money you're saving. Are you, are you in a state like California? If you're in California, Your 1031 is going to save you a huge amount of money, and I think that it makes sense for you to complete your transaction even though you're probably overpaying for it. If you're in a state that has no state tax, then things are different. So in my mind, it's really about which state you're in and how much money are you really going to save. I think that you're really in a difficult position. I don't envy you, and you don't really have a lot of outs. One option to consider is, if you really feel strongly that you're going to end up overpaying, is to use the opportunity zone methodology. That way you have 6 months for this whole thing to settle down, where with 1031, you really only have 45 days.
And last question, guys. A couple people have asked, what would you recommend for approaching sellers directly right now? Direct mailers, how would you prepare to get ready to take down some deals in third, fourth quarter? Like, what do you think for somebody newer starting out, getting into a market, is the best way to approach sellers today?
I think just get out there and approach them, because I think that what we've seen is some people that have been kind of on the fence about selling. You know, they may be older, maybe they're looking to retire, whatever their situation may be. This may just be the stuff that pushes them over the edge. Like, all right, I'm out. Like, I'm done with, you know, all this stuff. So I think it's always a good time to be out there and talking to sellers.
I have a little bit of data around that too. We have a cold calling team, and we've made around 5,000 calls from last September to January to owners, and we got in touch with a little over 300 owners. And you know, out of that, I think maybe 20 were interested in selling, not at reasonable prices. In the past month, we've had another almost doubled that number just in 1 month on the amount of sellers that have come back around and wanted to sell their properties. So keep following up, keep hitting those same people that were not interested in selling 6 months ago. They might be interested now.
I think every strategy works. I mean, this is just a great time to reach out. So it doesn't matter if you're doing mailers, doesn't matter if you're doing broker outreach. We tend to do a lot of broker outreach. It's just everything that you're doing right now with regards to sellers is 2x, 3x more effective than it was 2 months ago.
Yeah, and remember, not everybody can like choose to wait. Again, it could be the end of the term. It could be somebody could have died. It could be a family that owns that property right now that wants nothing to do with it. It could be circling around waiting for somebody to hit the flashlight. So I mean, there's all the kinds of reasons, right, that people need to sell: divorce, death, disease. I mean, there's always reasons to sell. So you just never quit. I mean, that's the thing with reaching out to sellers, right? Never say never. You just have to keep going at it all the time.
Something
Divorce,
interesting.
I'm gonna call that Maureen Miles' 3Ds: divorce, death, and disease. I haven't heard that one before, so I'm gonna steal that, Maureen.
There you go.
That's a real estate.
The 3Ds.
Yeah.
There was a property we're under contract in Fort Worth right now, 170 units. The seller did not agree to put it under contract in January. We were a day out from signing the contract, and she backed out because the broker told her she could get more for the property. It's off market, and it was true. And so it came back around in March, and you know, we got her to agree in the 3-day time frame that the stock market fell to about the Dow fell to about 18,000. And she wanted cash, short-term cash, so that they could go put it in the market. That's one of the driving forces, the reason why they sold it to us. I mean, you know, still it's gonna be 4 months till you get the cash, but they wanted cash in this short-term market to be able to deploy it in other areas. And so we got a deal under contract because of a short-term emotional decision that a seller made at a great price. And there are a lot of other scenarios where you can take advantage of that kind of stuff.
Awesome. Well, that's all great stuff. We really appreciate everybody's time here, and thank you for the audience for some great questions. I'll kick it back over to Kevin to kind of wrap things up here.
Thank you so much, you guys. David, Maureen, Neil, can we get a virtual applause for everybody and imparting all your wisdom today? I'm going to share your contact information so you can take a screenshot of this. We'd love to have, hold on one second, people be able to contact you. So here is David's information. Take a screenshot, please. We'll also send this out to you guys as well. Neil, Maureen, once again, you guys are fantastic today. Incredible knowledge. Thank you very much. And we hope to, I guess, continue to learn from you guys as we go through and progress through the COVID situation. I'll throw up our situation, our info as well. Hold on a second. I photoshopped this last minute. So if you have any questions for myself, Brian, or Mandy, drop us an email as well. We'd love to help out however we can. So thank you guys so much for everything. And we appreciate your time.
Thank you. Thanks,
Yeah,
everyone.
everyone say some prayers for Glenn and his wife, by the way.
Yeah.
She just got out of the hospital today. That's why he couldn't make it. So if you guys can all keep her in your thoughts, so we would greatly appreciate that. So
Thank you so much. Yeah.
Thanks
Thanks,
for joining
everyone.
us at last minute, David. And everyone, look forward to our series that we'll be doing on passive investing throughout the summer to keep this webinar series rolling. So thank you so much. We'll see you soon.
Take care.
Wash your
Bye.
hands.
thanks.
Everyone wash your
Thank
hands.
you.
Yeah, wash your hands.
Later, guys.
Feet.
Yeah.
Thanks, everybody.
Bye.